Welcome back to the Deep Dive. Today, we are strapping in for an intensive, highly targeted deep dive into a piece of essential global financial infrastructure that, for high-level institutional investors like you, often represents a fascinating puzzle. FactSet Research Systems, FDS.
It really does, because this company isn't just a standard data vendor. It's quite literally the operational nervous system for thousands of the world's largest asset managers, pension funds, and investment banks.
It's the plumbing, the mission-critical, high-friction wiring that sits deep inside the analytical and reporting workflows.
That's it. And our mission today is laser-focused on durability. The core question we have to answer for you, the experienced investor, is this. How durable is FactSet's competitive moat as it executes this massive, technologically intensive strategic pivot under new leadership?
Because the ground is shifting under everyone's feet.
It is. And FactSet is making some huge capital decisions to try and shift faster than the threats around it.
Exactly. We've synthesized the research, and the investment tension here is palpable and, frankly, pretty extreme. FactSet has all the hallmarks of a quality compounder. It's stable, high retention, largely non-cyclical,
All true.
and yet it currently trades at a steep dislocation compared to its closest high-quality peers. We're talking about names like S&P Global, MSCI, and Moody's.
And that dislocation is not small. It's a 50% discount we're looking at.
Right. It's sitting around, what, 18.3 times forward earnings right
Yeah.
here?
And that discount is the anomaly we're here to dissect. I mean, any multiple that low for a business with 95% plus retention suggests the market is pricing in one of two things.
Structural decline
Or permanent stagnation. Exactly. So our job is to critically unpack why that perception exists versus what the underlying reality might be.
and specifically, we have to look at their big strategic investment, what everyone is calling the AI tack.
We do. Is this capital allocation decision a necessary defensive move to fortify their moat and secure the firm's terminal value? Or is it a detrimental drag on profitability that's actually signaling weakness? That's the core of the debate.
So let's ground ourselves first. FactSet serves approximately 216,000 financial professionals every single day. It truly is the engine room of the buy side. Before we even get to the pivot, what are the foundational elements that give this investment thesis its durability?
So the durability really comes down to three things. Three big structural advantages that have, very little to do with raw data volume and everything to do with workflow integration.
Okay, so number one.
First is workflow centricity. They are not just selling you a data set. They are selling deep integration into a client's own proprietary mission-critical models.
They're not just providing the ingredients.
Right. They're customizing the entire kitchen for every client, making sure their data flows directly into valuation spreadsheets, into performance attribution systems, you name it.
And that focus on integration, not just access, is key. Which I guess brings us to the second advantage, the architectural philosophy.
That's the open platform. And this is where FactSet really differentiates itself from the classic walled gardens, like, say, a Bloomberg terminal. They went with an API-first approach very early on.
Which lets clients pull the data into their own environments.
Exactly. They can ingest that data seamlessly into their own cloud, be it Snowflake, Azure, AWS, whatever they're using. And this aligns perfectly with the growth of quantamental investing, which is a trend we definitely need to spend some time on.
And then third, the financial discipline. The hallmark of a quality compounder, which you absolutely need to weather a heavy investment cycle like this one.
Precisely. The third advantage is exceptional capital efficiency. This company is a high free cash flow generating machine. And crucially, they've proven they can successfully digest that massive HUSIP acquisition from 2022.
They're deleveraging fast.
Very fast. They're on a clear path toward gross leverage of roughly 1.5 times by the end of 2025. And that gives them immense financial optionality for buybacks, for M&A, for dividend growth, all while they're funding these necessary AI investments.
Okay, let's unpack this moat, because when you're faced with a 50% valuation discount to your peers, that moat has to be exceptionally robust. The sources all describe FactSet as a sticky ecosystem. What are the undeniable metrics that prove this operational lock-in?
Well, the proof is right there in the consistency of their core metric, the subscription engine. We track this through the annual subscription value, or ASV.
That's the forward-looking metric.
Right. It's highly predictable recurring subscription services. It stood at about $2.4 billion as of Q1 fiscal 2026, and it's still showing respectable organic growth, hovering around 5.9% year over year.
But the growth rate doesn't really tell the story of the stickiness. The retention rate does.
That's where FactSet truly shines. I mean, it rivals the best enterprise SaaS companies out there, who, by the way, are often valued at multiples twice what FDS is getting right now.
So give us the metric that provides the clearest defense against commoditization.
It's the ASV retention rate. It has been consistently, and I mean remarkably, greater than 95% for over a decade.
Over a decade.
Think about the volatility in the markets over that period. You had this 2008 financial crisis, sovereign debt crises, the 2020 pandemic, and through all that systemic shock, FactSet retained essentially its entire dollar revenue base.
That kind of resilience implies something deeper than just a contract. It's operational lock-in.
It has to be.
So let's get specific on the mechanics of that. For a major global bank, saving a few $1,000,000 by switching vendors might seem rational, but they don't. Why? What are the switching costs that create such a high barrier to exit?
Well, the costs aren't measured just in dollars and contractual penalty. They're measured in sunk human capital and, proprietary IP risk.
Yeah.
When a bank or an asset manager builds a complex mission-critical model, whether it's for an LBO or an expected loss model, that model becomes intrinsically tied to FactSet's specific data taxonomy and their proprietary identifiers. We have to talk about FDS codes.
Right, the FDS codes. That term gets thrown around as jargon. For you, the critical investor, explain what that is and why it functions as such a powerful point of friction.
An FDS code is FactSet's proprietary internal ticker for a company or a data point. It's not like a public ticker that might change. The FDS code is their unique, stable, internally mapped identifier.
So every cell in a spreadsheet.
Every single cell in an analyst's valuation model, every line in a risk report, every historical data pull, it's all tagged with these codes. To switch vendors, the client would have to completely map, reconcile, and rewrite every single line of proprietary code and every spreadsheet macro to the new vendor system.
That sounds like a project that introduces an immense amount of execution risk, which is the kiss of death in that kind of environment.
Exactly. It's a multi-million-dollar, multi-year project with a high risk of error, and an error in a valuation model could cost the client far more than the FactSet subscription itself.
Plus, you have to retrain everyone.
You have to retrain entire cohorts of analysts and PMs, people who are just used to the FactSet interface. So you can see why the retention rate is 95%. The switching cost is all about workflow risk.
That frames the stickiness beautifully. Now, let's pivot slightly to the architectural philosophy that underpins us, the open architecture. I have to challenge this a bit. In a world where data is increasingly commoditized, doesn't being open, letting clients pull data easily via APIs, actually reduce the friction?
That is an excellent, critical question. And on the surface, yes, an API-first approach does seem less sticky than, say, a closed terminal.
Right.
But FactSet is playing a different game. They are not selling scarcity. They are selling utility and clean data delivery. If you look at the big competitor, they built a walled garden where the data is trapped inside their expensive terminal. FactSet realized that for the quant investor, the risk manager, and the middle office, that model is, well, it's obsolete.
Because quants don't want to look at a screen.
They don't. They want clean, verified, high-quality data streams piped directly into their proprietary algorithms running on their own cloud infrastructure.
So the strategy here is that FactSet becomes the indispensable data utility pipe, not just a front-end application.
Precisely. And this API-first approach lets FactSet dominate two critical, fast-growing workflows where the traditional terminal is just ineffective. The middle office, so risk, compliance reporting, and the quantitative strategies group.
And in both of those, data has to flow freely.
It has to. It has to mix and match with internal systems, with alternative data sets. FactSet meets the client where they are in their own data lakes, which cements its status as essential infrastructure.
And this positions them perfectly for the modern reality of quantum investing. Can you quickly clarify for the listener how this trend specifically mandates FactSet's open architecture?
Sure. Quantimental is just the convergence of old-school, fundamental, human-driven research with new-school, quantitative, algorithm-driven analysis. Today's portfolio manager isn't just reading a 10K.
No, they're running complex factor models, overlaying proprietary scores.
Exactly. And to do that, they need FactSet's high-quality fundamental data, but they need it in a machine-readable format that can be easily accessed by a Python script or integrated into a platform like R. The walled garden actively stops that. FactSet enables it. That's why they're winning in these high-value segments.
But despite this move to APIs, we can't ignore the flagship product, the workstation superpower. Why does the desktop interface still create such a high barrier to exit when the future is all about data feeds?
Because the future isn't uniformly distributed. While the quant desk is moving to APIs, the vast majority of investment professionals, the PMs, the banking analysts, they still live on their desktop. And user experience matters immensely here.
And theirs is just better.
It is. FactSet consistently provides a superior UI/UX compared to the command line interface of its main rival or the often cluttered tech of Icon. It is simply faster and more intuitive.
But the true operational lock in the superpower that translates into huge switching costs for investment banks, it's not the aesthetics. It's the tight integration with Microsoft.
That's the key insight. Look, we have to consider the daily reality of a junior banker. These folks spend up to 80% of their time in PowerPoint and Excel.
I believe it.
Think of a junior analyst at 3 a.m. trying to finalize a pitch book. They are not going to pull up a command line terminal to check data. They need the FactSet Excel plugin.
Which allows for dynamic updating.
Right. If a client changes one input, a macro forecast, a valuation multiple, the analyst changes it in FactSet, and the entire multi-tab Excel model updates instantly.
And even more crucial is the PowerPoint integration.
That's where it's a lifesaver. It automates updating pitch books, ensuring charts and tables are correctly formatted and branded with a single click. This utility automating high-frequency, low-value tasks within the environment they already live in is priceless. It saves hundreds of man-hours per year per analyst.
Making it indispensable.
Absolutely indispensable. And if we connect this to the bigger picture for you, the investor, the modern moat is never just about the software. The interface is only as valuable as the content inside it. And what's fascinating here is the deliberate 2-decade-long pivot FactSet executed. They moved from being a sophisticated aggregator of third-party data to becoming a true content owner.
Hardening their IP moat.
Exactly. That shift to vertical integration is critical for sustaining margins and differentiation, especially as general financial data becomes, more widespread.
And the sources confirm that now over 90% of FactSet's ASV is underpinned by proprietary analytics and enriched content. That's a powerful defense.
It demonstrates real foresight. They knew that just aggregating and cleaning data was a path to margin compression. To justify premium pricing, they needed proprietary IP. And 2 foundational acquisitions really stand out.
Okay.
First, back in 2008, they acquired the copy of the Thomson Reuters World Scope database, which they then enhanced and rebranded as FactSet Fundamentals. This was their definitive move toward independence.
It meant they weren't reliant on a third party, especially a competitor, for their core data.
Right. It secured data quality and continuity. And then the second key acquisition bolstered their ability to provide those specialized forward-looking insights.
Which was?
That was the 2013 acquisition of Revere Data. And this became the backbone of their very successful deep sector strategy. It allowed them to map granular industry relationships, supply chains, and, crucially, to go beyond standard financials.
Let's drill down on that deep sector content. The granularity edge. Why does the critical investor need to understand the difference between this and just generic GAAP financials?
It's the difference between looking in the rearview mirror and getting a real-time progress report. Standard GAAP financials are standardized, sure, but they are lagging indicators.
A portfolio manager specializing in hotels doesn't just need revenue.
Exactly. They need verifiable revenue per available room, RevPAR figures. A retail analyst needs same-store sales growth. A software investor needs metrics like verified ARR and net dollar retention.
So the deep sector strategy provides these specific operational metrics that are the true leading indicators of a company's health.
That's it. This level of granularity is essential for true peer comparison and forward-looking valuation. And for FactSet, the financial advantage is profound. By offering the specialized data, they increase their value proposition, they consolidate client spend, and they stop the client from needing a dozen other niche data providers.
It's an aggressive wallet share grab.
It is.
Now we move to the absolute pillar of financial stability on the balance sheet, the CUSIP Global Services acquisition. FactSet paid, what, $1.925 billion for this in 2022. For the critical investor, this seems to be the definition of a regulatory inevitability.
It is the ultimate regulatory toll road. I mean, it's a hidden monopoly. CUSIP identifiers are the mandated, non-optional standard for tracking North American securities, stocks, bonds, derivatives across the entire trade lifecycle.
Clearing, settlement, compliance, all of it.
Every security traded in the U.S. capital markets must have a CUSIP.
So that implies it's a non-negotiable essential utility.
Precisely. It's not something clients choose to buy, it's something they're forced to buy, like a tax or a regulatory fee. This guarantees stability. The financial profile of CUSIP is transformative for FactSet.
It introduces this ultra-high margin, ultra-low churn annuity revenue.
And it's entirely uncorrelated with cyclical client headcount. Instead, CUSIP revenue grows based on overall market complexity and new issuance volume. This business acts as a permanent defensive anchor for the entire company housed in their CTS segment. It provides a foundational floor of predictable revenue.
Which inherently justifies a higher valuation, even when they're investing heavily in AI.
Absolutely.
So to understand the overall resilience, let's look at the client-based diversification from the sources. How stable is this mix, and where are the strategic priorities for growth?
Well, the client mix shows a high degree of strategic diversification. No single client is more than 3.5% in total revenues, which is critical.
And the breakdown.
The institutional buy side is the biggest piece, about 48% of organic ASV. This is the core foundation. It's slow growing, but the focus is all on retention and cross-selling.
Then you have the high-growth vertical, which is key to offsetting weakness elsewhere.
That is the wealth management segment. It's smaller, about 15% of ASV, but it is growing exceptionally fast, around 10% year over year.
And they're doing that by displacing legacy tools.
Exactly. They're offering institutional-grade analytics tailored for financial advisors. It's a massive, underpenetrated market for them.
And the third segment, dealmaker sell side, is where the anxiety lies, given the potential for automation and consolidation.
Indeed. The dealmaker sell-side segment, about 19% of revenue, is the most exposed to the structural risk of seat compression.
When banks merge, analyst headcount shrinks, and workstation seats are lost.
Right. And this vulnerability is why FactSet's automation products, like Pitch Creator, are not just nice-to-haves. They are strategic imperatives designed to defend this revenue stream.
By making the remaining analysts hyperproductive.
You got it. And finally, the partnerships and CGS segment, roughly 18%, provides that stable, recurring utility revenue. It's the least cyclical, highest margin part of the business, and it stabilizes the whole profile when banking activity slows down.
Here is where the rubber meets the road and where the market's skepticism is most evident. The market is nervous about the investment FactSet is making in AI. Let's dig into this strategic choice and the immediate impact on profitability, the AI tax.
This is the central debate. This is what separates the short-term trader from the long-term investor here. FactSet is openly guiding for a structural step-up in both CapEx and OpEx to fund this shift.
And that results in a pretty significant margin impact.
It does. We're looking at a forecasted 250 basis point margin impact in fiscal year 2026. Adjusted operating margins are guided down from a peak of nearly 38% to a projected range of 36.3% in the near term.
So the market looks at that margin compression and sees structural decline, hence the 18x PE multiple. But you have to apply the lens of defensive capital allocation. Explain why this spending has to be viewed as essential.
Well, it must be viewed as a necessary defensive capital allocation decision made to secure the long-term viability of the moat. I mean, look, if FactSet had tried to maintain that 38% margin peak, they would have been underinvesting in the core tech requirements of the future.
Cloud-native architecture, proprietary AI compute.
All of it, plus the specialized talent you need. They are strategically allocating what we could call excess margin into these future growth drivers. If they fail to make this investment now, they risk being relegated to a legacy provider.
And then the sticky moat becomes meaningless.
It becomes meaningless in a world where new entrants offer superior AI-driven workflows. So they're trading 2 years of temporary margin pressure for decades of assured relevance.
So let's detail where this AI tax, roughly $110 to $120 million in CapEx for FY 2026, is actually going. The core AI offering is the intelligent platform. Tell us about FactSet Mercury.
FactSet Mercury is their large language model interface, but it's designed specifically for financial workflows. What makes it so essential and worth the heavy investment is its use of a technique called retrieval augmented generation, or RAG.
Right, a RAG.
Yeah.
This is a critical piece of jargon we need to define clearly. Why is RBAG the key differentiator that lets FactSet sell Gen AI to highly regulated financial institutions.
Because RAG is the antidote to the LLM hallucination problem. Standard LLMs are trained on general internet data and, they often invent facts or misquote sources.
Which you cannot have in finance.
You cannot. RH solves this by grounding every single response in verified proprietary FactSet data. Think of it like a peer-reviewed academic paper. Every output comes with a verifiable footnote that links directly back to the original source, the SEC filing, the company transcript, the proprietary data.
It provides the data lineage and audit trails that compliance teams demand.
Exactly. This is how FactSet uses AI not to commoditize data, but to fortify its premium offering and defend against just, generic public tools.
Beyond Mercury, the other highly targeted AI product is Pitch Creator, which is aimed squarely at defending that vulnerable sell-side revenue stream. How does GenAI save their bacon here?
Pitch Creator uses GenAI to automate the single most tedious, time-consuming part of investment banking, generating, formatting, and updating pitch books. It can generate initial charts, perform competitive analysis, and format text instantly.
What's the target for time savings?
Management is aiming for a 50% or greater reduction in the time a junior banker spends on creating presentations. This is the key defense strategy. If you can't stop the decline in headcount, you have to make the remaining seats hyper-productive.
And are we seeing monetization success early enough to validate this massive investment?
We are. The early returns are promising. AI-related sales saw a significant 45% sequential growth in Q4 2025, and management expects their AI solutions to contribute 30 to 50 basis points to overall organic ASV growth in fiscal year 2026.
So it's not huge yet, but it's a real validated monetization path.
That's it. It's early proof of concept that clients are willing to pay for these advanced RAG-powered workflows.
Now, the strategic pivot isn't just about tech, it's also about leadership. The CEO transition is highly symbolic. Let's discuss Sanof Viswanathan, formerly a senior exec at JPMorgan Chase, taking the helm in September 2025. What does this outsider choice signal?
It signals a focus on massive enterprise scale and global banking relationships. Viswanathan didn't come from a pure tech background. He came from JPMorgan Chase, one of FactSet's biggest clients.
So he understands the pain points.
He understands them at an operational level. His background in digital banking, global expansion, and wealth management at JPM aligns perfectly with FactSet's two major growth initiatives.
Okay, let's detail those. First, winning the private markets. Why is this such a major expansion of their total addressable market, their TAM?
Because the public market is consolidating, while the pool of global private capital is just surging. FactSet smartly acquired Cobalt to get a foothold in the limited partner, or LP, workflow.
So they're targeting pension funds and endowments.
Right. But the true magic is in the integration. FactSet connects its Cobalt platform with partner data like Crunchbase, Dun & Bradstreet, and overlays its own public market coverage.
This crossover investors can see their entire portfolio in one place.
Exactly. Public and private. A single, unified platform. This eliminates the need for fragmented systems and offers a comprehensive view that pure-play private market data providers just can't replicate.
And the second major prong, the area of the new CEO's deep expertise, wealth management expansion.
This vertical is already delivering 10% organic ASV growth. It's likely their most profitable source of new revenue going forward. They've successfully tailored their institutional-grade platform into the advisor workstation.
And the recent acquisition of LiquidityBook was the crucial final piece here.
It was. FactSet had the research and reporting tools, but they lacked execution capabilities.
How does LiquidityBook complete that picture and increase the stickiness?
LiquidityBook added a robust order and execution management system, or OEMS. So now, FactSet provides not just the tools for analyzing and planning a portfolio, but the ability to execute trades directly through the platform.
It transforms FDS from a research tool into a core operational utility.
It does. For financial advisors, moving their entire operational flow onto one platform creates massive convenience and further strengthens those switching costs. And if we connect this investment story back to the bigger picture, the balance sheet health and cash generation metrics are crucial. They confirm that this is a fundamentally high-quality business capable of absorbing that temporary margin compression.
Which underpins the whole bullish case for the valuation dislocation.
Exactly.
So let's review that quality. Despite the increased CapEx, adjusted operating margins are still robust at about 36.2%. But let's focus on efficiency, specifically return on invested capital, ROIC. That's the gold standard for measuring a large capital deployment.
ROIC is absolutely critical, especially when you're assessing the success of that $1.925 billion CSIP acquisition. Naturally, after the acquisition, ROIC dipped because of the huge increase in the capital base.
But the recovery has been aggressive.
Very aggressive, reaching an impressive 17.4% in 2025.
So what does that recovery tell you, the sophisticated investor?
It confirms that the CGS deal is proving to be highly accretive, it's generating substantial earnings, and management integrated it effectively. An ROIC of 17.4% is just, it's a validation of the high returns on the capital deployed.
And the return on equity reflects this as well.
It does. It's consistently high, ranging from 28.5 to 30.7%.
Let's talk about earnings quality. For critical investors, the relationship between net income and cash flow from operations often reveals the true health of a company's profitability. What does FactSet's ratio tell us?
It tells us the earnings quality is exceptionally high. FactSet's trailing 12-month cash flow from operations at $726 million is significantly higher than their trailing 12-month net income of $597 million.
And why is that positive divergence so crucial?
Well, in many companies, net income can be inflated by aggressive accounting or high stock-based comp. When CFFO consistently exceeds net income, as it does at FactSet, it's a strong indicator that the company's profitability is backed by hard, internally generated cash.
They're not relying on non-cash adjustments to hit their targets.
That's it. And with free cash flow estimated at a healthy $660 million for 2025, they have the war chest they need to self-fund the AI pivot and reward shareholders.
And moving to the management of that war chest, the capital allocation framework, how disciplined is management in deploying this capital?
They adhere to an established risk-averse pecking order. Priority 1 is always organic investment, that $110 to $120 million in CapEx for AI. Priority 2 is growing the dividend. 3 is buybacks, and only then do they consider M&A.
Okay, let's focus on shareholder returns.
Yeah.
FDS is known as a reliable compounder.
Absolutely. They are a definitive dividend aristocrat contender. They've raised their dividend for 26 consecutive years. They just announced a solid 6% raise in May of 2025. And the 28% payout ratio is conservative, so that dividend is safe.
But the real signal of conviction, especially given that 18x PE multiple we talked about, is the acceleration of the share buyback.
The signal is undeniable. Having successfully deleveraged down to their target of about 1.5 times, they are now shifting gears to aggressive repurchases. The new, significant $1 billion share repurchase authorization is a massive statement.
It's much larger than their historical pace.
It is, and its management implicitly stating, "We agree the market has fundamentally undervalued our recurring revenue stream." This buyback acts as a powerful support for EPS growth, and it shows management is capitalizing on that valuation dislocation.
Despite all this quality, we have to acknowledge the risks. For the critical investor looking at a 5-year horizon, what are the two primary structural risks that FDS has to navigate?
The first risk is the one haunting the sell-side segment: structural seat loss. The question is whether the permanent reduction in human analysts from M&A, from AI tools like Pitch Creator, will outpace FactSet's growth in other areas.
If a bank can get the same output with 30% fewer analysts, FDS loses 30% of its seat revenue.
That's the threat. Now, they're hedging this by shifting away from per-seat licenses toward enterprise data utility fees and API consumption. But the correlation between banking headcount and seat count remains a persistent risk.
And the second risk relates directly to the AI tax.
That is the cost of compute versus pricing power risk. Look, running these high-end LLMs, maintaining the Mercury R environment, it's computationally expensive. Tech costs were already up 13% in Q4 2025.
So the risk is that the rising cloud and GPU costs permanently compress their gross margins.
Right. If clients resist price increases for the new AI-driven modules, that creates a direct threat to that 36% margin floor management has established.
So we've established a high-quality business with disciplined capital allocation, an exceptional moat, and a credible strategic pivot. We now return to the core tension. What on earth justifies the massive 50% valuation discount?
We have to first understand the battlefield. FactSet operates in a highly rational oligopoly, the big four in financial data, and its strategy is defined by its specialization outside the trader's desk.
Okay, so let's position FDS against its rivals. How does it survive against the entrenched incumbent, Bloomberg?
Feast Bloomberg. The key is niche targeting. Bloomberg owns the trading desk. FactSet generally doesn't compete for that seat. Instead, FDS targets the rest of the firm.
The portfolio managers, the 50 supporting analysts, the risk departments.
Exactly. And for those roles, FactSet provides 80 to 90% of the needed functionality at a much lower total cost of ownership and with vastly superior integration into MS Office. They are the cheaper, more integrable alternative for research and modeling.
Then there's the direct rival in investment banking research.
Fees S&P Global's Capital IQ. Cap IQ is the primary competitor there. The competition is fierce, but FactSet maintains an edge on speed, reliability, and that crucial office formatting. And Pitch Creator is a direct, calculated assault on Capital IQ's stronghold in that workflow.
A leapfrog attempt on automation superiority.
That's the goal.
And the third major player, LSEG's Refinitiv.
V's LSEG's Refinitiv icon. Refinitiv is often the value play, but they have been consistently hampered by the difficulty of integrating all that legacy tech post-merger. FactSet consistently scores higher on customer support, data quality, and ease of use. They're leveraging LSEG's integration struggles to highlight their own seamless, open architecture.
This analysis points to a company that should be trading at a premium, or at least in line with its peers. Yet we return to the elephant in the room, the valuation anomaly. FactSet trades at 18.3x forward PE.
The multiple is the market's current verdict, and it is a baffling one. 18.3 times forward PE and just 13.2 times EV/EBITDA. This is the valuation of a business expected to experience permanent structural decline.
Let's put this in context. Just restate those peer multiples.
Sure. S&P Global trades at 35.2 times PE. Moody's is at 38.8 times PE. MSCI, another high-quality data provider, sits at 35.3 times PE. FactSet is priced at a 50% discount to this group.
What catastrophic assumption must the market be implicitly baking in to justify an 18x multiple for a 95% retention business?
The market is fundamentally misinterpreting the AI tax. To justify 18 times PE, the market has to be assuming either A, near zero long-term organic ASV growth, maybe 1 to 2%, or B, that the current margin compression is not temporary but structural.
That margins will erode permanently.
Exactly. And this view completely ignores the CUSIP regulatory annuity, the high-growth wealth management vertical, and the successful deleveraging. It suggests the market is pricing in decline, not a temporary investment. For an investor with an IQ of 175, this anomaly should be screaming potential arbitrage.
So this brings us to the intrinsic value and bullish case. Let's lay out the scenario based on management executing their pivot successfully.
Right, and the scenario is based on achievable goals. We assume FDS achieves mid-single-digit organic growth, let's say 5 to 6%, and can manage even modest margin expansion back towards the high 30s after this heavy investment cycle is complete.
What valuation multiple does that reasonable scenario support, considering FactSet's historical range?
Well, FactSet historically traded in the 25x to 30x PE range. If we assume a simple, conservative reversion to a moderate 25 times forward PE multiple, which is still substantially below SPGI or Moody's, and we apply that to the expected FY 2026 earnings of about $17.25 per share.
That implies a share price of...
It implies a share price of $431.
And considering the stock trades in the late 2025 range of $290 to $300.
That represents substantial double-digit annualized upside with a significant margin of safety. The analysis strongly supports a bullish outlook. It's a classic J-ARB setup growth at a reasonable price, where the market is mispricing a temporary investment as a structural threat.
That brings us to the conclusion of this deep dive into FactSet research systems. To summarize the thesis for you, FactSet's moat is exceptionally durable, rooted in high-friction workflow integration, proven by its 95% plus retention rate.
The balance sheet is anchored by the CUSIP acquisition, providing a stable, high-margin regulatory inevitability. And crucially, the current pressure on margins is not structural deterioration.
It's a deliberate, necessary investment. The AI tax to embed FDS into the next generation of financial workflows via its R-Edge-powered AI platform. The current 50% valuation discount appears extreme, offering a compelling margin of safety for the patient, critical investor.
And the critical risk, as we noted, remains seat compression. FactSet is hedging this intelligently by shifting its revenue mix away from the per-seat model toward the enterprise data utility model. However, given that management compensation is heavily weighted toward achieving ambitious ASV growth and EPS targets, the fundamental question for you to monitor over the next 18 months is this. Can the organic ASV growth from high-growth verticals like wealth management, private markets, and data feeds not just offset but permanently exceed the secular headcount risk inherent in institutional and sell-side banking? The success of that $1 billion share buyback rests entirely on management's ability to execute this difficult dual mandate.